We'll start from going over some of the theoretical background here. Why are we doing these adjusting entries? So this goes back to the idea, the differences between two types of accounting system. One is accrual accounting, one is cash basis accounting. So keep in mind that all throughout the semester we're trying to learn, remember, corporation type of accounting system. So if we're recording transactions, providing information for public traded companies, it's always using accrual accounting system, the first one listed here. Okay, so the concept here, really we covered it in chapter 2 already, just didn't mention that the name is called accrual accounting. What it means is that, remember there's an on-account term. Corporation may be providing services, providing goods on account. That essentially is exercising accrual accounting concept. Record revenue when it's earned, but not necessarily at the same date when cash is received. Okay, meaning that if corporation today sign a contract to provide e-learning services or legal services, financial consulting services, let's say the contract with this client is just for a month. So after a month of meeting time, when it reaches, let's say, the end of February, the corporation has readily provided the service according to the contract. Then by the end of this month, that will be the date to record service revenue. So even though when it reaches the end of the month, it's not the same date when cash is actually received by corporation, revenue is already recorded. And if cash is not yet received, then it's considered accounts receivable. So this is essentially exercising the idea of accrual accounting already. Recording revenue, recording either service revenue, sales revenue, regardless of whether cash is actually received on hand, it's already captured in journal entries. If cash is not received, then it's considered accounts receivable. It must have been a promise from client and customer that cash will be paid to your corporation later on. Okay, so that will be an example of revenue. For expenses, it's just the opposite. Now it's the case that corporation has not yet paid out cash, but let's say if rent bill is due, if certain utility bill is due, you have already used the benefit for a month or 2 months already. So you receive the bill, even though you have not yet paid the money today. Once you receive the utility bill, you see the rental bill or other types of expenses contract, then you'll be recording that transaction in journal entry, even though you have not yet paid cash. So if you use the benefit, you have used the location that you rented for a month already, you haven't paid the rental expense, you haven't actually paid the cash, you still record rent expense, and at the same time that will be recorded, the credit side will be accounts payable. Okay, so accrual accounting, the core concept here is that we record transaction as it happens. Doesn't necessarily mean that cash is received or cash is paid out. If it's not received, if it's not paid out, it's considered accounts receivable or accounts payable. Okay, so for all the public traded companies, the financial statements that you will be able to Google online from other finance-related websites, if you see financial statements, you can confidently assume that it's recorded under accrual accounting. So you will definitely see accounts receivable accounts, accounts payable accounts listed under financial statements if the company has actually have some promises that they made before. They already delivered the goods, provided the services, but they haven't received cash from clients or from customers. Or they purchased items, but they have not yet paid the money to other corporations. Then you will see liability account, accounts payables accounts under financial statements. Now, as opposed to that idea, some of the small businesses, just for simplicity purposes, they may be using cash basis accounting. So if they're not regulated by the SEC to actually officially disclose information every single year, they can exercise cash basis accounting and record transactions only when cash is received and cash is paid out. Okay, but this is not a method recommended by GAAP, because this actually sometimes delays some of the transactions recording time. So for example, the case that I mentioned earlier, if we provided goods to customer today, customer promised to pay a week later. Then under cash basis accounting, small businesses will not be recording anything today. even though the goods is already shipped out to others, or even though the services is already provided, the contract, the responsibility for the corporation side is readily done. But for cash basis accounting, these small businesses, they only record transactions when cash is actually received on the same day when they have the money on hand. Or another example, they already used the location for 2 months and they're paying rental next month, the beginning of next month, let's say March 1st. So even though they have the benefit, that they use up the benefit for 2 months or a month already, they're not recording rent expense until March 1st. So that's the time when they actually record the transaction journal entries. Okay, so cash basis is, in terms of recording the entries, is the opposite of accrual accounting. It waits until actual cash receipt and cash payment to record things in journal entries. But for these cases, if that's not the same day when goods are delivered, if that's not the same day when expenses are actually due, then there's a delay between actually providing the goods and recording the transaction. Okay, so this is not a method recommended by GAAP. All the public traded companies are using accrual accounting. Okay, so this slide here basically just summarizes what I talked about earlier. There's revenue. This is an example of, let's say, delivering flowers. This corporation delivers flowers to clients. They only record, under accrual basis accounting, they will record the transaction regardless of whether actually collecting money from client the very same day that this activity happened. Under cash basis accounting, then whenever a check is received, cash is received, that's the time point when this journal entry is being recorded. Okay, so there's a differences in terms of the date the transaction is recorded. If the cash is delayed, accrual accounting still records transaction anyway. If the cash is delayed, cash basis wait until the actual date when cash is received, then they record the transaction. Okay, so basically under cash basis accounting, you will not see financial statements have accounts receivables account. You will not see accounts payable account because, remember, they don't have the on-account idea. They only record transactions whenever there's cash. Okay, so you will not see service revenue accounts receivable, or you will not see certain type of expense, credit accounts payable. You will see the debit side cash, the credit side cash when there's receipt or payment of transactions. And depreciation, I will talk about this a little bit later during the chapter. So if you don't get this, that's fine. That basically represents the decline of value for long-term assets. So we'll be measuring that a little bit later. So if we take a look at transactions here, these are 2 cases. For accrual basis accounting, beginning part here, May 20th. So what does that transaction tell us under May 20th? The corporation side, they have service revenue increased, right? But do they have cash yet? No. May 20th, it's accounts receivable because the client has not actually paid the money, even though the service is provided. Corporation side is done, but they have not collected the money, so it's under accounts receivable. A few days later, a few weeks later, June 5th, cash is received, so we debit cash from the customer, and then we credit accounts receivable, which is the earlier promise of asset, earlier promise of cash receipt. We reverse that account and collect cash. If this same transaction was made under cash basis businesses, then this transaction will only appear June 5th when cash is actually collected. Okay, so you don't see the transaction recorded May 20th, even though that's the date that the service and goods are readily provided to customer. Okay, so there's a lag of recording transactions here for accrual basis accounting compared to cash basis accounting. Okay, so this is a revenue example. You will see accrual basis accounting have 2 transactions. Cash basis, only the date when cash is collected. So for expenses, the same thing. Under accrual basis accounting, whenever the bills are received, that means the benefits you have readily used, this is the date when the transaction is recorded. Under cash basis accounting, only the date when the cash is actually paid out. That's the day when expenses is recorded. So if we look at transactions here, so the first transactions tell us that the company has purchased office supplies and did not yet pay the cash. When it comes to June 3rd, that's the time when they reverse the liability and actually make the payment, $200 worth of supplies. Okay, now under cash basis accounting, you see again there's only one transaction on the date when cash is actually paid out. Okay, now have you noticed another difference here in terms of the account names? Supplies expense. So accrual accounting here, we record the supplies that we purchased, we haven't used up as office supplies. Under cash basis, for any current asset, any asset that lasts no longer than a year, is directly recorded as expense account. Okay, so there are two differences for expenses. Besides the time lag issue, besides recording just one transaction when cash is actually paid out, another difference is that if this asset, in Chapter 4 we'll be going over the different types of assets, what is considered long-term, what is considered short-term. So for all the short-term assets under cash basis accounting, when we purchase it, it's directly considered a type of expense and not a type of asset. Okay, so this is another minor difference here. But the main focus throughout this semester is still accrual accounting. You just need to know what are the differences, different points here compared to cash basis. So we'll not be doing a lot of the transactions under cash basis because this is not recommended. So focus more on accrual accounting. Just notice the differences here. All right, just to summarize a little bit what we covered so far. Left side accrual basis, again, revenues recognized when it's earned, whenever the goods are delivered, services provided. Expenses recognized whenever expenses happened, when a corporation received a bill for using a certain type of benefit for a certain period of time. That's the day when the transaction is recorded, even though the money may not have actually been paid out yet. Cash basis, revenues were recorded whenever cash is received, expenses recorded when cash is paid out. Okay, so again, this is not recommended by generally accepted accounting principles. All the public traded companies uses accrual accounting basis. Oh. Okay, let's move on. The second part here, I'm going to define some of the terminologies that we haven't talked about in Chapter 2, and then we'll go over adjusting entries and some of the